Another year, another pile.
Okay, welcome everybody to this month's REI Tax Hunt.
Another year, another pile. Numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
We have a very special presentation today. This is a question I get asked all the time. Clients come to us and they say, I have been in business for 1 year, 5 years, 10 years. I'm thinking about starting a new business tomorrow. What should I be? An LLC, an S-Corp, a C-Corp, or should I just stay as a sole proprietorship? Well, the answer is it depends. And we are going to answer what exactly it depends today in today's webinar. So you are in here for a treat, okay? So let's get started. Who am I and why in the world should you listen to me? My name is Jason Malabute. I am a CPA. I've been a CPA since 2015, but I've been doing tax and accounting since 2013. So time flies when you are having fun. I'm also a real estate investor. I've been investing in real estate since 2018. Started off in single family homes, then transitioned into multi-family properties. I'm a general partner in multiple multi-family deals. Okay. I'm also a certified tax coach, which is a fancy title to say that I specialize in saving clients tens of thousands of dollars in average in taxes by doing proactive tax planning. So let's move forward. Okay, so if you are scrolling Instagram, if you're swiping on Tinder, if you are watching the NBA Finals, you want to put all that to the side, turn it off, pay attention, because we are going to be asking you a question at the very end to see if you have been paying attention. And if you get the answer right, you will get a special prize from us. So you don't want to miss out. Okie dokie, so let's talk about the basics. LLCs. It seems like every single person who thinks about starting a new business, they think that the first step is creating an LLC. This is probably because they saw something on social media saying that you need to start an LLC when you first start a business. So we're going to be talking about what's true and what's not true about LLCs, okay? Because contrary to popular belief, LLC does not save you money on taxes. But what does an LLC do? It provides legal protection, especially if you have real estate properties. And we're going to be talking about why exactly is that in the upcoming slides, okay? But remember that LLCs, if you don't elect otherwise, is taxed just like a sole proprietorship. What does that mean? That means that everything flows through to your personal tax returns. So that means that if you have a rental business, it's reported under Schedule E. And if you have an active business, it's reported under Schedule C. And we're going to be talking about why is that important in the next few slides. So you want to pay attention here, okay? So what is the primary purpose of an LLC? It's for liability protection, okay? It does not save you money on taxes. It's for liability protection. So for example, you have rental properties, you put into an LLC. So trips in your rental property, they cannot go for your personal assets. Once again, I am not a lawyer, so always talk to your lawyer first when it comes to legal advice, okay? So what's the best practice for rental properties and LLCs? Best practice is one property or one asset for each LLC. So you have 5 rentals, you have 5 LLCs, one rental in each LLC. But from a practical perspective, I know that that is not the most cost efficient way a lot of times. Okay. So every time you have a LLC, there are state fees involved, filing costs, and tax preparation costs as well. So that's why a lot of real estate investors don't apply the best practice of having one asset per LLC. So another alternative, if you want to limit liability for your rentals is to have umbrella insurance. So umbrella insurance is insurance on top of your current insurance, so that just in case something happens and the liability is above and beyond the coverage of your current insurance, then you have the umbrella insurance to cover that liability that's outside of your current or primary insurance coverage. Once again, if you are thinking about going down that route of putting multiple properties into one LLC and getting umbrella insurance, once again, talk to your lawyer and talk to your insurance personnel before moving forward with any decisions on legal protection or insurance protection. Okay, so what are the downsides to LLCs if you do not elect to be treated as a corporation? Because remember, one of the strengths to being an LLC is that there's flexibility. You could elect to be treated as an S-Corp or a C-Corp. Okay, so that is something to keep in mind. So if you don't elect to be treated as a corporation, by default, you are treated and taxed like a sole proprietor. What does that mean? Your entire net income subject to self-employment tax. That's 15.3%. So that means that if you net $100,000, that means that you're going to be paying $15,300 to self-employment tax. That's a lot of money because in 5 years, that is over $75,000 in self-employment taxes. That's a lot of money. Okay, so something to be mindful about. So why do people put rental properties in a LLC? It's because rental income is considered passive income, which is not subject to self-employment tax. Exception is if you have an active operations like a hotel, or sometimes some rare situations with Airbnbs, they could be considered active income, which would be subject to self-employment tax if not structured correctly. Okay, so when should you consider an S-Corp, right? So whenever you have an active business, whether it's flipping, wholesaling, real estate agents, and let's say you make about or above $50,000, that is not a hard rule, but that is a trigger in my head that says, okay, we should start looking into S-Corp structure for this client for tax efficiency purposes. And I'm going to explain to you why an S-Corp might make more sense in situations like this shortly. So the reason why is because when you are an S-Corp, one of the requirements is that the officers who provide a service to the corporation, to the business, to the S-Corp, they are required to pay themselves reasonable compensation. And that reasonable compensation is the only amount that's subject to payroll taxes, which is 15.3% when you consider the employer share and the employee share. So let's do high level math just to make this simple. Okay, so let's say you net $100,000. Okay, so if you net $100,000 and you are a sole proprietorship or you are an LLC, 15.3%, you're going to be paying about $15,300 every year in self-employment tax. Versus if you elect to be treated like an S corp, and let's say we do a reasonable compensation analysis, well, only the amount that's considered salary is going to be subject to payroll taxes. So let's say your salary is determined to be $50,000. Well, that means that you'll only have to pay about $7,650 in payroll taxes per year. So that would be saving you about another $7,650 in payroll taxes, which would be about what, over $35,000 in 5 years. Imagine if you put that money into real estate or stocks or some other kind of investment. How much would that money grow if you did that, right? So that's why it could be very beneficial to you if you would consider a different entity type once you start making more money. And then what's cool is that once you have paid yourself a reasonable compensation amount, then any distributions that you make to yourself out of the profit from the business is not subject to payroll taxes. But what's important is that we do a reasonable compensation analysis for the officers who provide a service to the corporation, because we want documentation that shows how did we come up with this compensation amount to the officers, so that just in case you ever get questioned by the IRS, you can always say, well, here's the documentation of how we calculated the compensation amount for the officers. So that is key. I've heard